What if I told you California's housing market is forecast to grow 3.6% in 2026? Yet some cities are sitting on a ticking time bomb. The California Association of Realtors projects the median home price will reach a record $905,000 in 2026. Only 18% of households will be able to afford it. Headlines claim the market is stabilizing. Inventory is improving. Buyers are told to feel optimistic. But here's what those headlines don't mention. Beneath statewide forecasts, certain California cities are flashing the same warning signs we saw before the last housing crash. Overextended prices, investor panic, weakening job markets, and buyers who are tapped out. The difference this time, many homeowners and buyers are making decisions based on outdated assumptions about California real estate always going up. In this video, we're breaking down 10 California cities where home prices could crash in 2026, using real market data, economic signals, and trends that are already unfolding. Stay until the end and subscribe to HouseLine USA. The #1 city on this list has the steepest projected decline in the entire state, and almost no one sees it coming. Number 10, Oakland. Oakland has been sold as the better-priced option to San Francisco, but that story is falling apart fast. Over the past few years, home prices in Oakland shot up dramatically. Remote workers left expensive San Francisco and moved here in search of deals. Prices went way beyond what local jobs and incomes can actually support. The problem? That wave of buyers is completely done now. Sales are dropping. Homes sit on the market much longer. Price cuts are becoming normal. And here's what you need to understand about Oakland's pattern. When buyers pull back in this market, prices don't drift down slowly. They drop hard and fast. One of the biggest problems is people leaving the city entirely. Oakland keeps losing residents to cheaper, safer places. Some move to other parts of California. Others leave the state completely. When people leave, but housing supply stays the same, prices face downward pressure. There are more homes than buyers who want them. Add rising insurance costs on top of that. Add higher property taxes. Add ongoing concerns around crime and safety. You get a market where buyers won't stretch their budgets anymore. The desperation that drove prices up is gone. Many investors bought properties hoping for quick profits. Now they're pulling back or selling to get out before things get worse. That adds more homes to the already growing inventory. Oakland also relies heavily on tech jobs. If tech companies keep slowing hiring or if stock-based pay weakens, fewer buyers can qualify for today's prices. That's when overpriced markets like Oakland feel the pain first. If you're a homeowner, this doesn't mean panic, but it does mean being realistic about where the market is heading. If you're a buyer, patience could be your greatest advantage. Watching for rising inventory, more price cuts, and softening rental demand could reveal the best buying opportunities ahead. If you live in Oakland or are thinking about buying there, comment Oakland below. And don't forget to like and subscribe because the next city might hit even closer to home. Number 9, Sacramento. Sacramento is usually seen as one of California's more stable housing markets. But that perception might be overly optimistic and actually dangerous. Over the past several years, home prices increased dramatically as Bay Area buyers flooded into the city searching for affordable homes while working remotely. That massive wave of demand pushed prices well beyond what local incomes can actually support. Now, as remote work flexibility tightens and affordability gets worse, Sacramento is showing clear signs of vulnerability. According to Realtor.com's forecast, Sacramento is projected to see a 3.3% price decline by the end of 2026. That makes it one of the very few California markets with an explicit negative outlook. One major risk factor is heavy investor exposure. Sacramento attracted large numbers of rental property investors in recent years. They liked the strong rent growth and steady population increases. But as rents stop rising and expenses keep rising, investor returns are shrinking fast. When investors stop buying or start selling to exit completely, inventory rises very quickly. Markets heavy with investors experience sharper pullbacks when conditions shift because these buyers care about profits, not emotions. While Sacramento benefits from a large government workforce, that stability is misleading. Government jobs provide consistency and reduce unemployment risk, but they don't offer the high income growth needed to justify current home prices. At the same time, Bay Area buyers are becoming more selective, especially as tech sector uncertainty grows. If that inflow of higher income buyers slows significantly, Sacramento loses one of its strongest demand drivers. Another serious warning is affordability compression. Mortgage payments for median-priced homes have risen dramatically. This is pricing out first-time buyers who once formed the backbone of the market. With fewer entry-level buyers able to participate, move-up demand also weakens. That creates a chain reaction, slowing the entire market from bottom to top. Number 8. Riverside. Riverside is a classic spillover market. That's exactly why it could face big trouble ahead. During the pandemic boom, Riverside became extremely popular with buyers priced out of Los Angeles and Orange County. Home prices jumped because remote work made long commutes seem totally fine. But that's changing dramatically now. More companies are forcing workers back to the office. Riverside's notoriously long commute times are becoming a serious problem again. Buyer demand is starting to soften significantly. One of Riverside's biggest risks is stretched buyers. Many people bought homes at peak prices using aggressive loans and risky financing. They thought low interest rates would last forever. With higher mortgage rates sticking around much longer than expected, new buyers are struggling hard to qualify. Existing homeowners face mounting pressure if they need to sell or refinance. When affordability breaks down like this, it doesn't adjust slowly and gently. It reverses fast and painfully. Riverside depends heavily on warehouses, logistics companies, and service sector jobs. Those are the exact jobs that get cut first during economic slowdowns. If layoffs start hitting or job growth weakens significantly, housing demand can dry up almost overnight. Unlike wealthy coastal cities, Riverside doesn't have international buyers or rich luxury buyers to soften any blow. That makes sharp price declines much more likely when momentum fades. Another growing concern is rapid new construction. Lots of brand new homes are being built in and around Riverside right now. That's adding fresh supply to the market just as buyer demand is cooling down. When more homes are competing for fewer buyers, sellers eventually get forced to cut prices just to attract any attention at all. History shows inland empire markets like Riverside swing much harder than California's core areas. They rise incredibly fast during boom times. They fall hard and fast during busts. If broader market conditions tighten in 2026, Riverside's dangerous mix of stretched buyers, affordability problems, and economic sensitivity could put home values under serious pressure. Number 7. Bakersfield. Bakersfield became one of California's fastest rising housing markets during the pandemic, but that rapid growth is now working directly against it. Home prices jumped way faster than local wages could keep up with. The increase was driven largely by investors and buyers relocating from expensive coastal cities searching for anything affordable. The problem is that Bakersfield's underlying economy hasn't fundamentally changed at all. It still relies heavily on energy, agriculture, and blue-collar employment. These are sectors that get hit especially hard during economic slowdowns. When home prices rise faster than what people actually earn in a city like Bakersfield, the market becomes extremely fragile. Another serious warning sign is heavy investor concentration. In recent years, Bakersfield attracted tons of house flippers and rental property investors chasing quick returns and easy money. These investors are typically the very first to exit when appreciation slows down or rental profits start shrinking. As mortgage rates remain high and rents stop climbing higher, many of these investment properties could hit the market all at once. That creates a sudden spike in available supply. When supply increases rapidly in a demand-sensitive city like this, prices don't just stall and stay flat. They often drop quickly and decisively. Bakersfield is also highly sensitive to migration trends and population movement. Many buyers moved to Bakersfield out of pure necessity rather than actual desire. They were seeking affordability and cheaper housing, not lifestyle improvements or career opportunities. If job prospects weaken or commuting becomes less practical with rising gas prices, those same households may relocate again to find better situations. This creates major instability in long-term housing demand. At the same time, insurance costs are rising dramatically. Utility bills keep climbing higher. Property taxes continue to increase year after year. All of this is squeezing homeowners who already stretched their budgets to the absolute limit just to buy at peak prices. They have no cushion left for these rising costs. Number 6. San Diego. San Diego might seem like an unlikely candidate for a housing downturn list. That's exactly what makes it dangerous to overlook. This is a market where prices have climbed to extreme levels, way beyond what local incomes have grown. Even small shifts in buyer demand can trigger big price corrections in markets stretched this thin. While San Diego remains highly desirable with great weather and beaches, desire alone doesn't keep prices rising when nobody can afford to buy. And that affordability breakdown is already happening. One of the biggest warning signs is the massive affordability gap. San Diego consistently ranks among the least affordable cities in the entire country. Buyers need exceptionally high incomes just to qualify for median-priced homes. As mortgage rates remain high, the pool of qualified buyers continues to shrink every month. When fewer people can afford to enter the market, sellers are forced to compete harder. That means price reductions rather than waiting indefinitely for a buyer who may never come. San Diego is also heavily exposed to interest rate sensitivity. Most buyers need financing to purchase. Even small rate increases significantly impact monthly payments at these high price levels. This slows demand very quickly. Additionally, parts of San Diego are vulnerable to job concentration risk. The economy leans heavily on tech, biotech, tourism, and military-related sectors. Any slowdown in these industries can ripple through housing faster than people expect. Another overlooked factor is the luxury and coastal home segment. High-end markets historically peak first and fall first. When wealthy buyers pause purchases because of stock market volatility or economic uncertainty, transactions dry up almost immediately. That slowdown then spreads downward into mid-range neighborhoods, creating a ripple effect. Add rapidly rising insurance costs, add stricter regulations, add growing homeowner expenses. Even long-term owners who bought years ago may start reconsidering whether holding property at peak valuations makes financial sense anymore. San Diego doesn't need a full-blown crisis to see noticeable price declines. In markets stretched this far beyond basics, even a modest demand shock can lead to meaningful corrections by 2026. Number 5. Santa Monica. Santa Monica sits at the end of California's housing price spectrum. That's precisely why it carries unique and serious downside risk. Home prices here have reached levels that only a tiny fraction of buyers can actually afford. The market depends heavily on wealthy individuals and luxury demand. When economic confidence is strong, that works fine. But when uncertainty rises, luxury buyers pause first. And when they do, price corrections can be swift and surprisingly sharp. One of the biggest vulnerabilities is buyer saturation. Prices have climbed so high that very few new buyers are left who can absorb additional supply. Even a small increase in available homes can tilt the entire market balance. Homes start taking longer to sell. Sellers begin negotiating and making concessions. Suddenly, the idea that prices only go up starts fading. In ultra-expensive markets like this, what people think and feel matters more than fundamentals. Santa Monica is also highly exposed to stock market performance. Many buyers rely heavily on equity compensation from tech companies, investment gains, or asset sales to fund their home purchases. If financial markets turn volatile or tech company valuations weaken, buyers delay major purchases like luxury real estate. This creates a demand vacuum that pushes prices down even without mass layoffs or recession. Another serious pressure point is rising ownership costs. Property taxes on multi-million-dollar homes are massive. Insurance premiums keep climbing higher. Maintenance expenses are substantial. Local regulations keep getting stricter. Some longtime owners who bought years ago may choose to sell while prices are still near historic highs. That adds inventory to a market with limited demand growth. Rent controls and regulatory constraints also reduce appeal for investors. That cuts another layer of potential demand. Santa Monica doesn't need widespread distress to see falling prices. In markets elevated this far, thin demand and shifting sentiment are enough to trigger corrections. By 2026, even modest economic pressures could mean noticeable price declines. Number 4. Stockton. Stockton sits at the highest risk on this list, and the data proves it dramatically. Stockton currently leads all of California with 25.4% of home listings getting price cuts. That's the highest rate anywhere in the entire state. That's not a small warning sign. That's a market where sellers can't find buyers at the current asking prices. They're cutting prices aggressively just to generate any interest at all. On top of that, Stockton is forecast to see a 4.1% price decline through 2026. That's one of the steepest projected drops in the entire nation. The problem with Stockton is built on weak long-term fundamentals. During the recent housing boom, prices increased largely because of speculation and affordability spillover, not because of strong job growth, rising local incomes, or high-paying employers moving into the area. When housing markets get driven by the logic of "it's cheap compared to somewhere else," Rather than real, sustainable demand, they're often the first to break when conditions change. The local economy in Stockton is extremely limited. It relies heavily on warehouses, transportation, and low-wage service jobs. There's very little income growth to support higher home prices. Very few new buyers can step in if demand slows even slightly. Once affordability tightens or credit conditions get tougher, buyer activity can drop sharply. In markets like Stockton, that drop has an outsized impact on prices. Another major risk is investor dominance throughout the market. Stockton attracted house flippers and rental property investors looking for fast appreciation during the boom years. These buyers are typically short-term focused and money-driven. If prices stop rising or rental profits drop, they sell quickly to cut losses or lock in gains. When multiple investors exit at the same time, inventory explodes dramatically. Prices fall fast with very little resistance from remaining buyers. Number 3. Palo Alto. Palo Alto is often seen as untouchable in real estate discussions, a market that only goes up because of Silicon Valley wealth and influence. But even the most elite markets aren't immune to housing corrections. In fact, cities like Palo Alto can be especially vulnerable because their prices are driven by a narrow base of very high-income buyers. When confidence weakens at the top of the market, demand can disappear faster than in middle-income areas. With home prices already at extreme levels, Palo Alto has very little margin for error. The biggest risk factor here is deep dependence on the tech sector. Palo Alto's housing market ties directly to the performance of Silicon Valley companies. Many buyers rely heavily on stock-based compensation, annual bonuses, or big liquidity events to afford these homes. If tech stocks remain volatile, or if companies continue cutting costs and reducing hiring, purchasing power falls dramatically, even for high earners. When equity markets dip or tech company valuations fall, luxury home buying tends to freeze first. Buyers who were ready to spend millions suddenly step back and wait. Sales stop immediately. Another often overlooked issue is transaction volume. Palo Alto has a relatively small number of annual home sales. That makes pricing more volatile than people realize. When just a few sellers reduce their prices to attract the limited pool of qualified buyers, it can reset neighborhood property values quickly. In high-priced markets, perception and sentiment matter greatly. Once buyers believe that prices have peaked or might decline, they often choose to step back and wait rather than risk buying at the top. That hesitation increases downward pressure on prices. Palo Alto also faces rising ownership pressure. Property taxes on multi-million-dollar homes are substantial. Maintenance costs are expensive. Insurance premiums keep climbing. Strict local regulations make ownership increasingly difficult and costly. At the same time, remote work has reduced the necessity of living close to Silicon Valley offices. Number 2. Modesto. Modesto tops out as the single most overpriced housing market in all of California. That distinction alone should raise serious concerns. A massive 32% of homes in Modesto are currently overpriced. That means buyers are paying far more than the underlying fundamentals actually justify. California residents and others looking for a more affordable cost of living have flooded into markets like Modesto. That drove prices to unsustainable levels. But the economic base and job market in Modesto haven't expanded nearly enough to support these high prices. When a market grows faster than its fundamentals, it becomes extremely sensitive to even minor economic shocks. One of the biggest vulnerabilities in Modesto is limited economic diversity. The local economy relies heavily on agriculture, food processing, and service sector employment. While these industries provide jobs, they don't generate the kind of strong wage growth needed to justify current home prices, especially with mortgage rates remaining elevated. When affordability tightens in a city like this, buyer demand can disappear almost overnight. Modesto also lacks a deep and diverse buyer pool. Unlike larger cities, it doesn't benefit from international buyers, major corporate relocations, or strong investor demand to support prices during slowdowns. This means there are fewer backup buyers ready to step in when current sellers need to exit. If even a modest number of homeowners decide to sell because of job changes, rising costs, or financial stress, inventory can spike quickly. That forces prices down faster than many expect. Another serious concern is that over 22% of home listings in Modesto are already experiencing price cuts. That's one of the highest rates in California. This suggests sellers are struggling to find buyers at current asking prices. They're being forced to reduce prices to attract any attention. When this pattern spreads across a market, It can create a downward spiral where each price reduction resets expectations for the entire area. Number 1. Victorville. Victorville is a textbook example of a market that can rise fast and fall even faster. During the pandemic housing boom, this high-desert city saw an explosion in demand from buyers searching for cheap entry-level homes after being priced out of Southern California. Prices increased at an unnatural pace, but the underlying fundamentals never caught up. That gap between price growth and economic reality is what puts Victorville at serious risk moving into 2026. The local economy in Victorville remains extremely limited. There are relatively few high-paying or stable job opportunities available. Many residents depend on long-distance commuting to jobs in other cities or remote work arrangements, both of which are increasingly uncertain. If remote work continues to shrink, or if gas prices and transportation costs rise further, demand for homes this far from major job centers could drop sharply. When demand weakens in a city like Victorville, there's very little to stop prices from sliding down. Another major red flag is speculative buying throughout the market. Victorville attracted investors and first-time buyers who believed prices would keep climbing simply because they were low compared to coastal markets. Many of these buyers stretched their finances to the limit. They assumed refinancing opportunities or continued appreciation would bail them out later. If home values stagnate or decline, those assumptions fall apart quickly. Forced sales become more likely. Victorville is also highly exposed to inventory shocks. New construction and resale listings can quickly outpace buyer demand. Unlike dense urban areas, there's plenty of available land here. That means supply can expand faster than demand can absorb it. When that happens, sellers are forced to compete on price rather than features or location. Historically, high desert markets experience some of the deepest corrections in California during housing downturns. They thrive during booms driven by cheap money and speculation. They struggle significantly when market conditions tighten. As you can see, housing markets don't crash randomly or without warning. They crack and break precisely where prices have outrun reality. Whether it's overvaluation, heavy investor pressure, weak job growth, or shrinking buyer demand, the warning signs are already forming and clearly visible across these California cities right now. That doesn't mean you should panic and make rash decisions, but it absolutely does mean that being informed and prepared is smarter than being surprised and caught off guard every single time. Look at the common threads running through all these cities. Prices climbed way faster than local incomes could support. Investors flooded in chasing quick profits and are now starting to exit. Job markets either lack diversity or depend too heavily on vulnerable sectors. Buyer demand is thinning out as affordability completely breaks down. These aren't small issues that will fix themselves. These are structural problems that take time to correct. What makes 2026 particularly concerning is the combination of multiple risk factors hitting at once. Mortgage rates are staying high longer than expected. Remote work flexibility is disappearing as companies force a return to the office. Insurance costs keep climbing across California. Property taxes continue rising. Economic uncertainty is growing both nationally and within key California industries like tech. When all these pressures combine, markets that are already stretched can break quickly. The cities on this list share one critical vulnerability. They all experienced rapid price appreciation that wasn't backed by fundamental economic improvements. Whether it was spillover demand from expensive coastal areas, speculative investor activity, or temporary remote work trends, the foundations were never strong enough to support the price levels we're seeing today. For homeowners in these cities, now is the time to be realistic about your situation. Understand your local market conditions. Watch inventory levels closely. Pay attention to how long homes in your neighborhood sit before selling. Notice if price cuts are becoming more frequent. If you found this breakdown helpful and informative, hit the like button right now. Subscribe to HouseLine USA so you don't miss future housing market updates and analysis. Turn on notifications to get alerts when new videos drop. Drop a comment below with the city you live in or the city you want me to analyze next. I read every comment and use your suggestions for future content. Stay smart, stay patient, and I'll see you in the next one.